My name is Robert Marson. It's May 22nd, 2026, and we're in the midst of a ripping bull market, especially in technology stocks these days. I'm lucky enough to have some of the AI technology plays, but I could have had more. How I purchase these stocks and how I intend to sell them is all part of a process for me. It's a formal buy and sell process. And when you hear my story, you'll understand how I invest and how I try to tilt the odds in favor of each individual stock position that I choose in my portfolio. So a little history. I started right out of college in the stock market business. I had done a test and it said I was a good salesman. My family was from very modest roots, and I went to college, came out of school, decided I wanted to sell things, and I learned that selling stocks was the most lucrative job in the sales part of the U.S. economy in the early 80s. So I started becoming a stock seller, and that's the definition of a retail broker. So after doing that for a while, I read lots of books and created my own formula in my 20s and used that formula to get a job at the biggest institutional portfolio management buy side, is what we call it, firms in the country, called Miller Anderson and Sherritt. And that was probably in the late 80s, and worked there till 2000. We sold the business. I had retirement money. And a few years later, I decided to start a hedge fund. So I ran a hedge fund for about 5 years. And after the hedge fund in 2010, I was able to just run my own money. And it's a great business if you're your only client, because when you screw up, you only have to yell at yourself. You don't have to feel bad about losing money for friends, families, or customers. So since 2010, I've been managing my own portfolio, although I do get a lot of requests to manage other people's money. I share my ideas with other interested investors on Twitter and on our show, Wall Street Beats. And let me tell you how the sausage is made. So back to the process. When I first started in the business, I didn't have a process, and I bought stocks that were recommended by my brokerage firm, Smith Barney, and they did okay sometimes, and other times they didn't do so well. And I figured if I wanted to have a long and happy relationship with my clients, I should try to do something that would increase their odds of succeeding with my investment ideas. And after about 3 or 4 years, I decided to put a buy screen together that would increase the odds of success. And the first thing I noticed in my first few years was that stocks typically, even good companies doing well, had significant drawdown periods. When the stock market went down, or when there were issues or potential issues around the company's fundamental outlook. So I decided I would only buy a stock after it had its own private bear market. Better that it happens in a general bear market, because then all the stocks go down and you have better companies. But every stock that I purchased would be down, say, 25 to 65% from its 52-week high. And that removes the risk of having, top tick the stock and just gotten wiped out before you even had a reason to be concerned about the fundamentals. So there has to be a material decline in the stock before it hits my buy screen. The second thing is it has to do that to compelling valuations. Now, there's not just an absolute valuation parameter. It's relative to the company's growth rate. So if a company's growing 20% and it drops to 20 times earnings, that's very cheap for that growth rate. If it's growing 10%, it drops to 10 times earnings, that's very cheap for that growth rate. So it's a sliding scale dependent upon growth rates. But I don't buy 52-week highs. I don't buy expensive stocks. So today in the stock market that I just commented on, this rip roaring, there's insane valuations for technology stocks related to the data center build out supporting the AI movement, in my opinion. And there's not a lot there that I'm buying today because of that. And finally, it has to drop this 30-40% to these very attractive valuations. But it has to do that on solid fundamentals. decent growth or a short-term blip in the company's growth. And what do I mean by that? Well, if the stock drops 50% and it's theoretically cheap, but the earnings are falling off a cliff, that's not going to be cheap. So my third parameter to buy a stock is there needs to be a flat-ish to slow growth or high growth, but disappointing growth earnings outcome. And it's not going to be a company that kills it fundamentally because they're not going to get cheap and they're not going to plunge. What usually happens is a company is in a growth period, sets a high bar and grows, but might not meet a very high growth forecast embedded in the stock. Or there's a reason to believe a competitor has announced a new product, or there's a tariff, or there's a trade war, or there's a political issue with the company's industry. There's lots of reasons that companies can do okay and the stock go down and get compellingly valued. What we don't buy, 52-week highs, we don't buy expensive stocks, and we don't buy stocks that are down and theoretically cheap on imploding fundamentals. That's the catch the falling knife thing. That's the value trap idea, and we try to avoid that. We prefer growthier companies than not because the stock market often gets excited about them, but we are not confined to just high growth stocks. I've invested in probably every business and every industry. I've probably analyzed 10,000 companies in my career. And, I've been doing this since 1982. So you look at a lot, you develop a lot of institutional education about businesses, industries, and companies. So I have a small list of industries and companies I won't touch because the competitiveness is too harsh for the companies and they don't make money. But other than that, I'm pretty comfortable dealing with semiconductors as easily as teen apparel or shoes, food stocks, as well as natural gas pipeline companies. So my industries are not confined. I'm not a specialist in any one business. I have had the most success in technology, hardware and software, telecom, semi-cap equipment, semiconductors, industrial equipment, that kind of stuff in my 44-year career. But I'm willing to invest, in most industries. So I run a computer screen every couple of weeks. It has those three parameters. It generates the raw ticker symbols and companies and some financial data. And then I go to work on analyzing if I held this business for 3 or 4 years, what's the growth rate? What's the profit margin? What's the EPS potential after that growth period? What would the relative valuation be, considering it's being valued as a growth company and not a company that's not growing or stuck in the mud? There's a lot of companies that aren't going to grow a lot over 5 years because they're just too big or in businesses that don't offer that. And I try to avoid that. So one thing I learned about how the market value companies is that it does pay a premium for revenue growth. And it's more important today than it's ever been. When I started in the business, I bought cheap stocks that were too cheap to be true, even if they didn't have a growth story. And then after doing that for 10 years, it took me 10 years to figure this out. I realized that you buy General Motors because it's cheap. And 10 years later, the same stock price with a company doing the same revenues and the same earnings per share as it did 10 years ago. That's not benefiting from the idea of compound growth, compound returns to the stock. So I stopped buying cheap stocks. I had a decent career buying cheap stocks, don't get me wrong, but it was more akin to buying something at 8 times earnings, selling it at 15 times earnings, and maybe doubling your money in a couple of years because the stock was fully valued at 15 times earnings. But over time, I realized that the best winners, the 5, 10, 20 baggers, come from buying a company as a value stock when it has a period of growth that's less than expected. It has negative revisions. The growth and momentum investors puke the stock to compelling valuations. You have to understand what the reason for the growth slowdown is and why it's going to resume in the future, growth that is. But when that happens, if that happens, you get the compound growth from the business over 5 years, and you get the significant multiple expansion, because a value stock could trade at 10 or 15 times earnings. Growth stocks trade at 25 or 35 times earnings. So you're going to get if they double their sales in 3 or 4 years and double their valuation, that's a four bagger. So you're going to buy something at 10, it goes to 40 in 3 years. That's the kind of stocks that I'm looking for. When I target a stock, it's not for a faint of heart. It's not a stock that will go up a little or down less in a bear market. I'm not investing to make 10% a year or 12% a year in a company, in a big safe company. Now, there are people that do that. That's not what I aspire to in my growth portfolio. The numbers around my typical stock investment would be visibility to 2 to 3 times my money in 2 to 3 years. And that comes from a 3-year financial model that delivers an earnings per share level, a fundamental outcome, a growth outcome in revenues and profits that at a valuation that's fair for that growth rate in 2 to 3 years will double or triple the stock. So we're not trying to invest for income here. We're not trying to invest for defensiveness. We're not trying to invest in name brand companies that most people know. In fact, most of the stocks I buy and have shared on Wall Street Beats over the last couple of years have been stocks that most people, if I were investing in stocks that everybody were comfortable with and knew of, and there was very little ability for me to out-research other investors, that wouldn't offer me the upside in a position that is outsized appreciation. And if I run a portfolio of 10 to 15 of these, say, at any one point in time, and I'm successful in 2/3 of them, and my losers don't kill me, then I should have well above market returns in a portfolio of these stocks. So let's go through an example. So a stock is doing well. They have their business in a growth cycle, but they're in a cyclical growth industry. There's a company in Philadelphia called Intest, and it's a small cap, and I'll use that because I've traded this well enough to make a very good point on the buy and sell process. So Intest was chugging along, and it was a cheap stock, and they were not doing much. They hired a new management team about 5 years ago, and the stock was about $6. I think it had peaked in its upcycle at 12 bucks. The stock goes to 6. They decided to hire a new manager. It came on my list. They were making enough money to be down and cheap without imploding the business. At the time, the stock overreacted to the down cycle, and I became a shareholder. And upcycle came. The company made enough money to go to 12 and 15 and even 18 the first time. So I decided to sell some stock. There was recession fears after that, about a year later. So the stock went back to 10, even though the business was holding up okay. So I bought the stock that I sold back. It got picked up by a growth manager and a bunch of growth managers, a famous one named Louis Navalier. That drove the stock to 25. And I sold my entire position at 25 because it became fairly valued. Then the company had its third down cycle of the past 15 years. And just last year at 6 to 8, I reestablished a significant position in the stock. Today, it's about 17 or 18 because that was, last year was the Trump trade tariff tantrum that drove a lot of stocks very cheap. And I knew there'd be a decent semiconductor upcycle for this AI build out and that they would participate. So I think I've taken 3 doubles to triples out of the same stock in the last 6 years. So it's an example of buying something that simply overreacts to modest disappointment, gets compellingly cheap. Companies' balance sheets have more cash than debt usually, because I don't like leverage in my businesses. That gives you a margin of error. Yes, if the company delivers on its potential, that double triple is an idea that, is sort of what I'm shooting for in my portfolio. An example of something that worked better is a company called Bel Fuse. And Bel Fuse had been around forever. I had circled it forever because it was always expensive and I didn't understand why. They make fuses and electronic doodad. power equipment and specialty connectors. And, the stock had a history of trading between 10 and 12. And a couple of years ago, 4 years ago, it had gone from 20 to 12. It was not making any money. It was very cheap, undermanaged business. And I decided to buy the stock at 12. And they had brought in a new management team. Again, there's a catalyst for a business that was underperforming. It was down. They were making about $1.40 that year when it went from 20 to 12. So 20, it was a 13 or 14 PE, which is probably fair for its history. But when it dropped to 10 in a general market correction, 10 to 12, you had a situation where it was 7, 8 times earning. And it was under earning tremendously. This was a company who should have been making $4 or $5 on its revenue base and was only making $1.50. But it was cheap, and there was a new CEO, a CFO who knew the business very well. So the company started to turn around, and within 3 years, they had made $6 and $5, and the stock had run to 90. So I had a lot of profit in it. I realized a lot of that profit held on to some. They then became known as an data center electronics supplier, which gave them another leg up, and the stock recently hit 300. So the trade would have been 12 to 300. My last stock was sold at 150 because that was my interpretation of fair value. My original sell target was around 100. I bumped it up to 130 when I saw the year they were going to have, and at 150 I was gone, and it doubled after that. So sometimes when you have a value bias and you tend to be very rational and you're looking for the next 3-bagger, you tend to sell early. So to sum it up, stocks go down, they get compellingly cheap for a fundamental outcome that's not certain. There's always going to be a risk. And that's why the stock goes down in the first place. You have to buy, unlike technicians who like good charts, by definition, my charts are going to be not good. Some will be ugly, some will be blah, but they're not going to look like a chart that, is a reason that you want to buy this because the chart looked good. That never happens with my type of purchases. So the fundamentals occur after the purchase. I'm right on the fundamentals. The stocks usually double, triple, quadruple. If I'm wrong on the businesses, with any luck, I could break even on most of my losers. So the idea is to pick 10 stocks, win on 6 or 7, and there'll be relative winners. There'll be a combination. So an obvious winner in a position is the 3X in 2 or 3 years. That sounds quaint today when things 3X in a month, but over 44 years, that's the normal outcome. Today's not normal. It's way too aggressive. And then you have winners where the stock goes up double or half, 50%, and the earnings don't match what you think. So you're fairly priced that way. And I consider that to be, an okay outcome. And then there's some stocks you break even with because the fact that the stock already dropped a lot was pricing in this news. And then there's the occasional thing where you try to catch the falling knife and it goes through your pile. And I probably get one of them every year, sometimes 2 out of the 10. And in those things, you're just trying to manage your losses. So as soon as you realize the knife went through your palm, you try to sell the stock. You don't marry it. So that's how the buy process works. There's a lot of fundamental research done around the competitive dynamics of the business, the company's, growth and growth opportunities and risks. There's analysis of the products and the competitive dynamics of the business. And, a lot of fundamental research. I talk to managements and Wall Street analysts regularly. I'm not investing on sound bites or stories. I'm not investing on charts or patterns of stars in the sky. It's a lot of deep fundamental research and making bets. If it's probably not the right word, making investments founded, good fundamentals, good businesses, okay managements, great balance sheets so you don't have bankruptcy risk, product cycles and end markets that offer above average growth. And when the investment community turns sour on what heretofore was a great story because it was a growth stock, it was very expensive. And then the company stumbles and gets cheap. And that's when they hit my new purchase screen. And that's when I do my research and and pick my long positions out of that universe. And that's how a Robert Marson long portfolio gets positioned. To wrap it up,